Good morning. It's August 27th, Friday, 5:42 a.m. Welcome to episode 15. Good morning to you, Wowie, and to our
Morning.
listeners. Good morning, sir. I hope everyone had a great week so far. This is your host, Mark Yu.
And Wawi Santos.
Welcome to the Mark Yu and Wowie Show. A disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wowie are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. The show's goal is to share and learn from each other, answer questions to our co-workers in the medical field. Thank you all for your hard work. We are available on YouTube, Spotify, and Google Podcasts. On our previous episode, we discussed the federal minutes or the FOMC, the changing consumer and investor sentiments, smart money movements, and we also took a closer look at the Illinois-based ATI physical therapy that went SPAC and how it lost fortunes for its investors. For those who have missed it, please feel free to go back and listen to it. All right, on today's episode, we're gonna take a closer look at the initial claims. Let me pause the video. All right, cut. So for our initial claims, it looks like it's ever going down. So it's a good sign for our U.S. economy. Um, as of August 21st, it's down to 353,000, whereas a year ago it was more than doubled at 872,000. On this next article, it shows here, and Time magazine shows when does extra unemployment end? And these are the 25 states ending extra unemployment. This was published on August 5th. As well, we have mentioned earlier on in our previous podcast, 51% of the states were ending their unemployment benefits. So included in some of the states here: Alabama, Alaska, Arizona, Arkansas, Idaho, Iowa, Maryland. So there are a bunch of states already had taken off the gas pedal off of unemployment insurance. But so far, according to an article by The Economist, which was published on August 20th, about a week ago, so far, ending pandemic unemployment aid has not yielded extra jobs. American states that cut off supplemental benefits have seen increases in hardship, but not in employment. So it looks like it has yet to show up in the data, Wowie, in terms of like people getting back to work despite having a lot less of unemployment benefits.
Stimulus effect until they start losing some of their savings, from spending. People won't
Exactly.
go back to work.
Yes, savings rate is still down about 50% from high of March 2021. That's this year. It's down from 21% all-time high to down about 9%. So people still have a bunch of savings in their accounts. So they're not my thoughts and my I guess my speculation is people are still enjoying their savings, their cushion, and not going back to work right away. So it is definitely reflected in this CNBC article, Wowie. As of a couple days ago, they published this article entitled "The Great Resignation." The Great Resignation is likely to continue as 55% of Americans anticipate looking for a new job. So not only people are just sitting on their couches, but those who are actually in fact working at this point in time, 55% or half of the 2,400 adults on the survey published by Bankrate are likely to look for a new job in the next 12 months. It says here the survey comes at a remarkable time given the experience of the past year and a half, said Mark Hamrick, senior economic analyst at Bankrate. There have been a lot of epiphanies. And this reminds me of what you just said on our previous episode, Wabi. There have
Yes.
been a lot of epiphanies and reckonings that have occurred during the time with respect with how we are prioritizing ultimately our values and of course how work fits into that.
Yeah, that's during our interview with Peewee
Uh-huh.
when I said there's a nationwide reset.
Mm.
So this, I guess, is job resignation, job reset post pandemic.
Even he in this article, included in this article, shows how to prepare to leave your job. So I guess it's definitely people are not like really looking forward to getting into a job in a hurriedly manner. They're taking their time and making sure that they're gonna jump onto the next job fitting their own lifestyle or work lifestyle.
Yes.
Um, so here's a chart for St. Louis Fed Financial Stress Index. As the title itself, it's self-explanatory, looking at the different degrees of financial stress in the markets. We're still on a 5-year low, even like if you're gonna look at this closer since 2017, stress financial index or financial stress index is still way down. So not a whole lot of people invested in the stock market and the financial market are being stressed out during these times. Um, here, another article here by the Bloomberg, published on August 19th. It says here, as we have promised on our previous episode, we're going to take a closer look at the real estate market. So we have a bunch of slides coming up for those who are invested in the real estate market or who are actually looking to purchase their home, like you, Huawei. I was looking
Mm-hmm.
forward to buy a new house in the coming days or coming months. So these are very important data as to showing where are we at the real estate market. So we're going to start with a Bloomberg article entitled Mortgage Delinquencies Sink to Pandemic Low as U.S. Jobs Return. So as the title says, it looks like it's a positive, overall positive, because delinquency means people are not paying their mortgage on time. This is in addition to the ongoing moratorium, or at least the one that has already just ended. Mortgage delinquency rates plunged in the second quarter to the lowest level since the pandemic began, as the improving economy helps distressed homeowners get out of trouble. The delinquency rate dropped to 5.47% of all loans outstanding, down from 8.2% a year earlier, the lowest since the first quarter of 2020, since the Great Lockdown.
That's a very good news, Mark.
Mhm.
That's very good news.
So people who have already owned homes are actually able to pay or get back to on track and paying their mortgage compared to the 08 09 great financial crisis, where it all all started from people not being able to afford their mortgages and started just leaving the keys and walking out of their houses. According to Marina Walsh, MBA's vice president of industry analysis, she said, it appears that borrowers in later stages of delinquency are recovering due to several factors, including improved employment and other economic conditions.
And I
He,
think
Mhm,
I would like to add to that. I think
mhm.
refinancing rates have gone down.
Refinancing
Um,
was mhm,
and so that probably had helped a lot of people get better rates to pay off their mortgage.
right. Yeah, refinancing rates for our listeners are the rates that homeowners or the already homeowners take whenever they cash out or try to get a lower rate from their previous mortgage settlement. So, for example, they locked in a mortgage, 30-year mortgage 5 years ago at 6%. Now it's like 4% or 3% even. So they can refinance and get a lower refinancing rate on mortgage. So
Exactly.
I think yesterday I saw an article from CNBC that the 30-year mortgage rate at least went down by a few percentage points from 3.06 to 3.03, but still above 3%, but not that much. Here's another slide. This is from MBA or Mortgage Bankers Association.org. They come up with a report every once in a while. It's entitled Share of Mortgage Loans in Forbearance Decreases to 3.26%. According to Mike Frantantoni, MBA's Senior Vice President Chief Economist, he said the largest decrease in a month in the share of loans in forbearance came from a jump in forbearance exits. So a lot more people getting out of the forbearance, the moratorium, as many homeowners are nearing the end of their forbearance terms. The forbearance share declined for all investor and servicer categories. New forbearance requests pick up slightly this week, so there's a slight increase, particularly for Ginnie Mae loans, but overall trends remain positive. So that's a good sign. People are getting back to paying their dues or mortgage. That reminds me of the whatever Greek or whichever Arabic. No, not Arabic. I guess mortgage came from Greek. Like mort of mortgage. Mort means mortality, so forever, for life, mortality, and
Mm.
then gauge short for engagement. So if you have a mortgage, usually you pay for a mortgage for your life, the rest of your life. Well, usually it sounds like that because a 30-year mortgage, unless you sign up for a 15-year mortgage, which is half of it. So personally, wow, if you're okay to share, would you prefer a 15-year or 30-year mortgage, like the length of the mortgage?
Well, like you said, it's like mortality. It's
Mhm.
like you're tied up for the rest of your life paying off something.
Yes.
Um, so from our experience holding the mortgage for 15 years worked out
Mhm.
best for our
15.
situation.
Wow. Because I know
Well,
if go ahead.
you can play it like, you can get a 30-year mortgage and just add, you know, additional payments to pay off capital. And you could shorten that
Mm.
mortgage life to, less than 30 years if you do it that way.
You like pay a little bit extra despite having a, because I know 15-year has higher payments, monthly payments, of course, because it's a short time period, but you get to pay a little less interest on that for sure. But 30 years, it kind of stretches out over time, so you have a little less payments. But the
Yeah, I
thing,
think there's just a few points less than the 3% that you would get on a 30-year mortgage right now.
right.
So when we pre-qualified, we got like 2.80 something
Wow,
for a 15-year mortgage.
that's good.
Uh,
Mm-hmm.
but I would advise people, if they're gonna, get pre-qualified, go ahead and check out the rates for 15 and 30.
Mm-hmm. You guys might want to head out to bankrate.com, bankrate.com. They have the rates there showing like a 15-year and 30-year. So here on our next slide, mortgage, another uh, article from MBA entitled "Mortgage Delinquencies Decrease in the Second Quarter of 2021." So it's sort of like reflects the previous article that we just showed. The delinquency rate for mortgage loans on 1 to 4 unit residential properties decreased to a seasonally adjusted rate of 5.47%. It says here by Marina Walsh, CMB, MBA's vice president. Mortgage delinquencies across all loan types, conventional, FHA, and VA, reached their lowest levels since the first quarter of 2020. The drop in delinquency rate for FHA and VA loans was the largest quarterly decline for both in the history of MBA survey dating back to 1979. We're making history again, unprecedented. Much of the second quarter improvement can be traced to later stage delinquent loans, those 90 days or past due, but not in foreclosure. She adds that, in fact, the 90-day delinquency rate dropped by 72 points. So we're getting a little bit too technical here. But some of the factors, because of the recovery here, she said, improve employment and other economic conditions, the availability of home retention workout options after forbearance, and a strong housing market that is bringing additional alternatives to distressed homeowners. So, for those who are out of the moratorium, there are still some loopholes or some assistance provided indirectly or directly by the government so that these people are able to maintain their payments. It says here, she further said, once the foreclosure moratoria lift and forbearance plans expire over the course of the next several months, we expect many homeowners to take advantage of available workout options to avoid the foreclosure process. So I guess everybody else will still be in a floating boat, not on a sinking ship, Wowie, because of these additional assistance, like workout options, as she said, to avoid foreclosure process.
Yeah.
So it's a good sign. I think somehow we still have support for the real estate market. It's not like it's after the moratorium, real estate would crash. So this is a good sign for those who are looking at the real estate market optimistically, especially for those who are eager buyers of the red hot real estate market. Next article, same publisher, MBA, Mortgage Bankers Association. They published this on August 17th, entitled July New Home Purchase Mortgage Applications Decreased 27.4%. So applications, Huawei looks like a dropping like a hot potato. This is more than a bear market. Bear market in the stock market is 25%, 25%. So
Hmm.
the applications for new home, this is interesting. People are retracting, probably postponing their applications for a new home. It dropped by 27%. According to Joel Kahn, MBA's Associate Vice President of Economic and Industry Forecasting, he said mortgage applications for new home purchases declined in July, as is typical. Oh, so it's typical. As is typical most summers when home sales start to moderate, but did come in at the second strongest July reading since the inception of MBA survey in 2012. Huh. Furthermore, the average loan size again increased to a new record of $402,000, 440. Home builders are still facing elevated building costs and accelerating home price growth from the continued imbalance between supply and demand. It looks like Huawei, despite this bearish sign of applications, a decline of 27.4%, this is still the second strongest July reading since
Hmm.
the survey was done or initiated in 2012. And the average loan size is still way up there. New record, 402,440. So people are still, despite the seasonality of it, as typical in most summers, according to Mr. Khan, vice president, looks like we're still up bullish in that's a little bit contrasting here, but you got to read between the lines. These are the experts. These are those people who know these numbers. So looks like there's nothing to worry about despite the drop in application of mortgage new home applications. In addition, he said, after adjusting for seasonal patterns, our estimate of annualized new home sales showed a jump of more than 10% from June. The housing market, he said, is still extremely competitive, and prospective buyers have increasingly turned to newly built homes because of for sale inventories remain so slow. Yeah, so that's why I was asking you earlier, Huawei, I guess.
Hmm.
So would you rather get yourself a new home, or like a newly built home, or like like a one that has been listed? Because it's been getting competitive for those people who are trying to get uh, purchase a house that's already built.
Yeah. Well, for both new construction and shopping for a home,
Mm,
it's still a supply issue.
mm,
You're gonna have to outbid. If you're looking for you know a home,
yes.
you're gonna have to outbid others that are looking for homes, and there's
Mm,
not a lot of them
yeah.
uh, out there right now. And if
Right.
there is, the owners will kind of gamify the situation by posting their home, and
Mm,
then if they're not getting good bids for it, they'll take it out of the market and then maybe repost in a week.
right. So this you've experienced firsthand, right? While you've seen this in some of the addresses that were previously listed, and they took it off and put it back in the market.
Mhm.
That's crazy. Well,
Yeah,
this.
so
Mhm.
they're kind of testing the market, and that's, that's what you expect when there's a short supply. Now, if
Yeah.
you're building a new home, you just have to expect delays, because right now the supplies for, fixtures and
Mhm.
um, construction supplies might be, unpredictable.
Exactly. Yeah. It's just going. Well, as you said, unpredictable. Just a month ago, couple months ago, lumber was selling for 1,700, and now it's down to 400.
Yeah. So
Yeah, it's hard to predict.
we were just talking about supplies, right? Building materials,
Mm-hmm.
but you also have to think of labor.
Ah,
Just a
yes.
few months ago, it's hard to find framers
Mm-hmm.
to build a new home because the framers are like uh, overwhelmed by the demand,
Uh-huh.
and so it's a framers market.
Right.
So
They're in demand. You gotta pay more.
they're
Builders gotta pay up more.
yes, to get them,
Mm-hmm.
so
So,
they can demand more a higher price for framing a new house because so
yeah,
many builders are wanting their expertise.
yeah. And you can never build a house without a frame. The skeleton.
Unless you want it to fall down.
Yes, it's bad. But yeah, so here's a chart, MBA consensus of new home sales. So they were actually looking, the consensus or the census is actually lower than what we had just registered, at least in previous months. So it's nothing to worry about here, despite the drop of 27.4% in new home purchase mortgage applications. So jumping on to our next slide, it's just showing here this is from apartmentlist.com. They
Mm.
sometimes publish their blog updating what the rental apartment rental market state is on that specific time. So since the COVID lockdown, we saw some drop in rents on a month-to-month basis. But since the start of this year, the monthly change every month in national median rent price has been ever increasing until at least June. And then it's kind of plateaued in July, but it's still above 2.5%, I would estimate. So there are a lot of rents. Well, the rents are climbing up in conjunction with the national home prices. So, including here, Google search volume for apartments for rent is like as high as it could ever be in the past 4 years. So people are definitely looking into places to stay, not just buying new homes, but also in apartments.
The
Um, the,
same bidding war is occurring in apartment, you
it
know,
could be happening
seeking.
as well. Yeah.
Yes,
Uh,
it is.
he,
According to a CNBC article,
oh, okay.
it's also hard for people to find apartments.
Right. Because as you can see here, another chart by the apartments list. This is a very helpful one. The high urgency or people who would like to move right away is like increased to 57%. While the low urgency, those who are not really looking forward to jump on different apartments or move, is low at 43%. They kind of flipped this year, thus probably supporting the reason why rents are still ever increasing. And this is quite stunning, Wowie. Despite home purchases and all that, probably the demand. Um, I'm not saying it's waning. It's seasonal, but it's still high, a record high at this point in time, according to Mr. Khan of MBA. But this chart here in apartments, apartment vacancies and the median price rent estimate, the their charts or their graphs have flipped. Vacancies are like way low in the past compared to the past 3 years, and the price way up. So law of supply and demand for sure. It kind of flipped beginning April of this year when rent prices have skyrocketed up from about $1,100 national median rent estimate per month above to above of 1,200 or almost $1,300, whereas the vacancy index have dropped from that point in time from 5% down to a little less than 4%. So prices are rising. Rent price is increasing while vacancies are going down. So
Part of the
yeah.
reason why they're
Mhm,
raising their rents, according to CNBC, is to
mhm.
offset losses from the COVID eviction moratorium.
Oh yeah. So
So
they're
they're
trying to
covering their expense.
exactly they're trying to claw back. And speaking of rent, so one thing that we could take a closer look at, specifically for real estate. So in stocks, we usually look at price to earnings, price to sales, price to cash flow, price to book. But on real estate, there's price to rent. So it says here in Google, the almighty Google, the price to rent ratio is the ratio of home prices to annualized rent in a given location. This ratio is used as a benchmark for estimating whether it's cheaper to rent or own the property. The price to rent ratio is used as an indicator for whether housing markets are fairly valued or in a bubble. So, what is a good price to rent ratio? The price to rent ratio is calculating, well, I just said that. A price to rent ratio of 15 or less means it's a better buy. A price to rent ratio of 21 or more means it's better to rent. So it's like echoing kind of interestingly what Benjamin Graham, father of value investing in the stock market, also likes the figure 15 for his price to earnings ratio. The 15 sounds like a magic number nowadays, I guess. So 15 or less, it's a better buy. 21 or more, it's better to rent. It means that the price is 21 times more than the rent. So let's see. This is an article by Economist, which was published in August 12th. Um, price to rent. This is like in different countries. So we're looking at just narrowing it down to the United States. So United States is at 19. So it's a little price is definitely going up. But look at New Zealand, wow, we 100.
Mm,
So if you're in New
wow.
Zealand, it's better to rent. No kidding. You probably have to rent. I mean, if you want to buy into real estate, look at less than 15 here. Which countries are less than 15? South Korea, 13. Greece, 5. Look at Greece, 5. Wow. Israel, 37. China. Oh no, China is NA, so that's not included in the chart supposedly. But yeah, Brazil is negative. No, NA. So I guess there needs to be a better data here, but this is published by the Economist. So this is as of second quarter. That's interesting. So US is at 19. Better figure to know. You might want to ask your realtors what's the price to rent in that city. So they probably is knowledgeable about these facts and information. Also, Wawi, I would definitely recommend because I'm also actively looking. I'm actually under contract for a quad or for a multifamily. The thing about it is your
Mhm.
realtor, the buyer's realtor, the one that will represent you at the table upon, submitting an offer, the one that's going to prepare the contract, needs always needs to be on your side because if this is the sellers or the listing agent's realtor, the one that you contacted off of Zillow, then the chance of you being able to negotiate a better deal with in terms of price and inspection contingencies, like for example if there's something like needs to be done before you want to close, like you want the seller to take care of this problem before you close, the realtor that's representing you would be the one hammering it to the listing agent and to the seller. So you are more empowered if you have a realtor that would represent your side instead of the one that you contacted or reach out in the website or Zillow or Realtor or whatever website that is. Just a tip.
Yeah, exactly. So you
Mhm.
have to establish a relationship with your realtor. And over the years, we have used a Century 21 realtor that's she's been really good to us and she's become our friend. And we also have one that's helping us out in Tyler.
Mhm.
And she's also well trusted and she's like you said, she's there to back us up and
Yes.
to help us locate, find the best deal
Uh-huh.
right now when we're right now as we're shopping for a new home
Right.
for
Well,
for our second home.
mhm. So realtors, this is basically their trade. They are trained for this. They have license for this. So they know which path to go to in terms of getting the best deal for their buyers. So definitely
Exactly.
you want to work with a good realtor. If you notice, if you feel like this realtor is kind of off, there are a bunch of out there. I remember at one point, right, while there was an article published first quarter of this year that there are more realtors licensed now than the number of houses being sold. So
Oh,
just watch out for the newbies or realtors. Nothing wrong against them, but you want to go with the one that has more experience for sure. So this is just a median existing home, so increasing up way up there, like the stock market. Um, US MBA purchase index. Purchase index includes all mortgages applications. So yeah, we just discussed this. So this is an article from Redfin. I think this is the most important article before we jump onto the stock market discussion. They have a bunch of charts in this. They just came out with this report, red hot, a couple of days ago. It says housing market update: median home price up 16% from 2020. We're just gonna right away jump through their charts because that's what our listeners want, and also for us, it's easier because I'm a visual learner as well. So according to Redfin, um, it shows here sales price is up 16% from 2020. So now, home sales price is at $361,000 compared to last year, up 16%. Whereas at the same point of time last year, August of last year, it was just around $312,000. So that's about how much? 61 minus 12. That's about $49,000 more this year. Well, who would have known, right? Back in August last year, we didn't even have the vaccine.
mm-hmm.
So now we have the vaccine. We had the moratorium, all the support that was provided by the government. So it's all good at this point in time, albeit a little bit pricier for sure. Next chart says asking prices on new listings up 10%. So people who are wanting to buy the house, they're offering at least an average 10% more, or at a value of $351,000. Whereas at the same point of last year, people are offering on average around $320,000, about $30,000 more offering. Pending sales. So these are the pending sales as self-explanatory, up about 10%, 71,647 units. New listings. So if there is more supply and demand, new listings would be higher in terms of growth. But new listings of homes nearly flat from 2020. So there are not much new listings as people buy, as we're going to see in a little bit, people take the property off the market quite quickly. It doesn't last long when it's listed. So right now it's just plus 1% in terms of new listings at 97,000 compared to last year's 96,000. So active listings of homes for sale. So there are not much inventory as we have been like discussing for the past couple months now. Inventory is definitely low. Active listings of homes for sale is down 23% from last year. Last year we had 861 active listings. Now it's down to 662%. It was, inventory wise, it has been ever um, reduced compared to last year. It started back in December when I think, we came out with the vaccine around November, right? So I think when people think that, economy is getting better, as is to the stock market, people probably started moving into houses or getting a better future outlook that they think that we need to buy a better place to stay in if we're gonna work from home or whichever situation they are in accordance to what is happening right now, which is the Great Resignation. So it kind of jives all together. Here we go. This is what I was referring to. The pending sales under contract. 49% of pending sales under contract within 2 weeks. So yeah, definitely. Um, once the property is listed, 49% of pending sales are right away under contract. Under contract means like the buyer has instructed the realtor that he's working with to write an offer letter for a certain amount of price for a property. And they're going to submit it to the seller. And if the seller accepts and signs on that offer letter, it becomes a contract. And the property thus is being taken out of the listings and becomes under contract. So nearly half of properties are now under contract within 2 weeks compared to 44% last year. 35% is under contract within 1 week. So earlier, 50% in 2 weeks, 35% within 1 week. So this is ever increasing compared to last year's 32%. So days on the market, the property that's actively listed in the market is down, or days on the market flat at 18 days. So it's flat 18 days compared to the previous month. But compared to last year, average days in the market was 34 days or over a month. So now after 18 days, more likely the home that's listed for sale has gone by the 18th day or 20 days. So another chart here by Redfin. This article right here is very like informative for sure. Over half of homes sold above listed price. So 52%, about 52% of homes or properties listed in either Redfin or wherever is sold above its list price compared to just 30%, 32% last year. So not much of a price drop here. Well, interestingly, there is. Over 5% of listings had price drops compared to last year's 3.6%. So there's still a chance to have a little bit of bargains because over 5% of listings had some sort of price drops compared to last year's 3.6%. And all right, the final chart of Redfin. I think this is the most important chart. The Home Buyer Demand Index. This is up 20% from 2020. So there's definitely a home buyer demand lurking around. So it's not just all fluff, like what do you call that? A fictional demand. Like it's for real. People are looking to buy their own homes. The demand index is up there, 20%. All right. Kind of like
and they can't keep up with the demand. Just for new buyers, just don't forget you can always haggle the price. If you see that there's something that needs to be fixed, like a roof, or there's a feature that you wanted, like a closet.
Oh yeah.
Yeah, your
Mhm.
chances of getting the home may be less than last year or years back,
Mhm.
but it always pays to haggle.
Right.
So so see if you could work that out if you
Yeah.
are looking for a new home right now.
Yep. Roofing issues and foundational issues. Those are the biggest ticket items, I would say. And then flooring, maybe a little bit, but roofing could cost you an arm and a leg. Could range from $5,000 to $10,000 for repair, as I personally experienced. And foundation, definitely, that's a way bigger ticket item, in comparison to whichever. Foundation could cost you over $15,000 to $20,000 on one give. So it's quite a hefty. So if there's a foundational issues, I'm not saying that you shouldn't proceed and buy that house, but definitely consider other options if you don't want to get into a fixer upper situation. All right. So we're on to go to our stock market discussion. It's going to be taking us a few minutes, not so much focus on that on this episode, but yeah, S&P 500 marks its 51st record of 2021, matching the most in a calendar year as stocks climb higher Wednesday. So this is published on August 25th. Obviously, yesterday was a down day for the markets, but we're at we're matching the most in calendar year. It's just incredible how this year's performance in the stock market is. We are now matching the greatest number of closing records to this point in calendar year since 1995.
And if
So,
I remember correctly, I'm just seeing like maybe 3
mm,
or 4 down months this year
mm,
on the S&P 500.
mhm.
So it's really a sign that a lot of people are bullish.
Yes. Well,
A lot of
as we're gonna
a lot of
tackle,
investors are bullish.
yeah, as we're gonna tackle right now for sure, while we that definitely reflects in the American Association of Individual Investors. As of a couple of days ago, their survey came out. Their question is this: what direction do AAII members or American Association Individual Investors feel the stock market will be in the next 6 months? So most of the investors, or 39.6% of AAII members, feel bullish. This is in comparison to last week's 33%. That's a good jump, 6% jump. And it's now even higher than the historical average of 38%. So 39.6% are bullish, definitely supporting the ever climbing stock market. 51st record, the most since 1995. Um, and obviously, the bears are slowly going that. Well, they're not like giving up on their stance, like 35% last week down to 33%. So they're still above the historical average of 30.5%. But yeah, bears are keeping their kind of skeptical or conservative side. So despite people are getting overly bullish, bears are kind of like maintaining their ground. Um, Volatility wise, Huawei has introduced this to our listeners a long time ago. The volatility, it just means the up and down of the markets, the wobbliness
Mhm.
has gone down for the past 5 days. It went down 17% since the start of the week. So it just means that the overall trend is still ever going up. The fear and greed index, it's no longer down there, but it's still above. It's still a little less than half, like 50%. It's hovering around 40% compared to a much more bearish stance not so long ago at 20% a couple weeks ago. The fear and greed index, what emotion is driving the market right now, according to this survey as of yesterday evening? Believe it or not, this one is fear. We're at fear compared to a week ago where we were at extreme fear. This is kind of crazy because American Association of Individual Investors reflects that the investors are way, well, not way, but above historical high bullish, 1% high. But this fear and greed index some sort of reflects fear. Okay.
That is probably current events,
Mm-hmm.
what's on the news, what's going on in Afghanistan
Mm-hmm.
is probably part of it.
It could be,
And
yeah.
then waiting for the Jackson Hole, summit.
Yes, it just
Uh,
commenced. I saw a notification. It just commenced, Wowie.
so
They're
it's
about
just
to.
on standby. People are kind of standby right now, just
Mm-hmm.
waiting for what Jay Powell is gonna say and
The Wall
what
Street, Wall Street
God
God. And
and
then, mhm,
and
go
what
ahead.
and what the economists there and central banks are gonna agree upon
Right.
during their meeting.
Yes. And of course, we shouldn't forget the Bitcoin Fear and Greed Index. Now it's about 50,000, right? Well, I haven't been tracking this, but
Yeah,
it's.
it broke resistance, so
Mhm.
people are bullish on Bitcoin again.
Yep.
And looking at the other developers, I saw a spike on Cardano
Mhm.
just last week and this week. Looks like Cardano is back on the map.
Yeah. So from last month it was neutral, but last week it was greed. Yesterday is greedy. Oh no, greed still, and today is greed. So all points to green. Greed is in vogue in Bitcoin markets. So the flow, we look at this from Bank of America. Looks like the Bank of America private clients are moving their money to tips or treasury inflated protection securities. So this is quite a stance in terms of people trying to prevent their portfolio suffering from inflation. So these are securities that you can invest in that will protect you. That's kind of like going with the inflation. If the inflation goes up, the returns on this goes up slightly, I think, or at least a percentage points higher than what the inflation is. So the overall goal of the TIPS securities is to avoid losing money in an inflationary environment. So this is where people in Bank of America are putting their money. Also, they've been moving their money into Japan. Not sure how they do that. Maybe buying ETFs of Japan, bank
Yes.
loan, utilities. And what's interesting is they're moving their money out of high yield. They're moving their money out of low volatility. So where's the financials here? Let's see. Financials actually receives a little bit of flow, but not so much. So that's interesting. People moving in their money into tips or treasury inflated protected securities. So far this week, energy has outperformed the rest as of Friday morning. Energy is the top performer, the best industry this week, followed by consumer cyclical, which is like the consumer cyclical. These are like, let's see, cyclical. These are airlines, furniture, cars, luxury items, and other discretionary spending. So interesting. So this is like betting at the reopening play again, Huawei, I think. Because energy is definitely a reopening play. People spend more money on oil or gas. People are spending. Cyclical items, luxury goods, airlines, and then followed by technology. And the worst performing industry this week, utilities and real estate. Huh.
Yeah. Well, speaking of consumer discretionary,
Mhm.
we still have a short supply of new cars. I think we already bought out all the used cars,
Oh yeah,
and now new cars are running out because of the chip shortage.
the Mannheim Vehicle Index. Actually, it showed a little bit of dip last week. So we talked about the consumer sentiment. People are slowing down in purchasing used cars. So interestingly, like you said, I agree with that. In addition to newly minted cars, newly minted, um, like Toyota, right? Last week we were just discussing. They're saying that they're gonna drop their production by 40%.
Mhm.
Ford had to cut down his famous, like ever so famous Ford F-150 production by the thousands because of chip shortage. So I think we're gonna reach that point in time where there will be some sort of equilibrium, but we'll see.
Yeah.
We'll see how
As
it goes.
far as far as the retailers, you also look at the bargain retailers like Dollar Tree
Mm.
and Dollar General. They're
Mm.
affected by the supply chain. So with the closure of the ports in China,
Yes. Uh-huh.
the the supply towards these bargain stores have been affected.
Uh-huh.
So you see a big drop in Dollar Tree and Dollar General
Their stock.
price
Oh.
shares because of this. But it should come back
Mhm.
as we get more
Oh dang.
supply.
Yes, sir. Down 12%, Wowie. Holy crap. This is just yesterday. It's like, did they report a bomb? No, I'm sorry for that word.
Mhm.
How did they do? Why? Because
Well,
of the drop?
because of the supply,
Ah,
it's not getting here.
right here. Yeah.
They're
Dollar trees.
highly
Hmm.
they're highly dependent on goods that are manufactured and shipped from China.
Overseas. Yeah.
And
Says here.
because of
Mhm.
China's zero COVID tolerance, they've been opening and closing this Ningbo port,
Ningbo.
and so
Yes.
that kind of slows down the supply chain again. So
Look
it's
at
still
that
a
shift.
supply chain issue.
Mm-hmm.
for for some of our retail stores. But you look at Target and you see there's a lot of movement there towards Target. A
Mm-hmm.
lot of other companies are using Target as their store. So
Really?
put it on your watch list.
Mm-hmm.
Look at how Target is gonna take advantage of this opportunity.
I think the big box retailers, Walmart and Target, are the ones who gonna survive nonetheless. Dollar Tree, I mean, all of them will survive, obviously, but in terms of like being able to keep more profit, I think the bigger you are, obviously, you could probably hire an entire vessel for all we know, an entire shipping vessel, what they call VLCC, or very large carrier cruise, or whatever that is. But yeah, that's a good point. Wowie, Dollar Tree slumped. Like, look at that cliff. It went down 12% just yesterday after saying that its international shipments are taking forever. Wow.
So you
So
look at shipping companies, so they're able to charge higher now.
yes,
So just probably a good thing to look at shipping companies because
shipping.
they can, they've raised their freight charges and they should be making a profit out of this
Yes,
high demand
some
for
sort of
moving items.
that kind of reminds me of a cyclical move as well, which is gaining at this point of time. So we probably need to take a closer look at some shipping companies for our next episode, Wowie, for sure. Um,
I I bought Zim early
mhm,
this year, and Zim is an Israeli shipping company, like I mentioned in the past episode.
mhm.
And there are others that are, you know,
What
that
about
are taking
FedEx?
advantage of this.
Yeah, let me look at FedEx right now. It made me interested. So FedEx is actually flat for the past week, not much. For the past year, up 5%, 6 months, about 2%. So I think people are that's some sort of promising. Let's take a closer look at the shipping companies for sure. FedEx, UPS, and all that. So now we're gonna proceed with our video clips. So this is an interesting point of view. This is coming from a guy who has a hedge fund and being interviewed for his experience with investing in Apple in the early days. Let's play the clip.
Barry, what's your best Apple story? Oh God. So I was a big Mac fan for a long time, and I got an early look at this newfangled iPod, not iPhone, iPod. And hey, this is the new Sony Walkman. At the time, I want to say Apple was $13, $15 with 13 in cash. So you were risking $2. My whole firm bought a ton of it. I held on to it and made fun of the guys who sold it when it was up $5. I sold it, it was a triple. And I'm like, look, I tripled my money. And then it just never looked back. And the lesson is, the trend is your friend. When something is working out, don't take the money off the table too soon.
So he tripled his money and took it out of the market, and then interestingly, we know where the story goes from there.
Hmm. Yeah, if you have a good conviction for a
Mhm.
stock pick, hold it for the long term.
Right. Just keep invested, and then buy the dips. Buy the dips
Yeah,
is the rule of the
most
day.
most experts would suggest holding a stock for at least 5 years.
Hmm. I think that's what Cathy Wood also tells her investors. They are looking for the 5-year run. So speaking of, here's a recent CNBC plug which garnered about 24,000 views, published just last night. Let's roll the clip.
It's now time for our Etf Spotlight, taking a look at Cathy Wood's ARK Innovation Fund, about flat on the year after quite a bit of volatility in the interim, to say the least. A new piece from Barron's highlighting that investors have pulled a net $2.7 billion from the fund since the end of June. This, of course, as Wood dipped back into the Chinese names this week through her fintech ETF. Take a listen to what she told Tech Check a week ago.
We have never said the Chinese names are uninvestable. What we have said is because of the social engineering, it seems, or re-engineering that's taking place in China, that the valuations associated with these companies are damaged, and we don't think they're going to go up anytime soon.
So remember, guys, this comes after she basically pared back all Chinese exposure just last month, now getting back into names like JD.com, taking 59,000 shares in that name, as well as Tencent Holdings, 235,000 shares in Tencent. Now, noteworthy, this is through her fintech ETF.
Right.
This is not through kind of their flagship innovation fund, but interesting nonetheless, especially in light of those comments made just last week.
Yeah, although it was a good trade. I mean, the stocks have actually been, despite.
So I guess criticism is up and running now for Kathy Wood after, bailing out early and then getting back on the trade. What do you think about this, Wawi, on Kathy Wood's stance or recent movements in just days interval?
Well, it shows that her fund is very agile. They will respond to changes in the market. And like she mentioned, she thought that the Chinese stocks were damaged because of the social engineering. But she's always been consistent with her talk.
Yeah.
And although some investors are pulling out of the ARK Innovation ETF and the other funds, I think they're still going to find value in her ETF. I'm still holding a few shares of hers, just as disclosure. And again, it's not an investment advice.
Right.
One of her biggest holding is still Tesla. So,
oh yeah.
and most people are long on Tesla at this time, with their two factories is still on standby, Germany and Texas. So we'll kind of wait another maybe 2 years to see if her thesis is correct. So if you're like a kind of person that would like to, see how this play with Tesla goes, you wait for about 2 years to see how it goes. If you're just on standby, it's good to watch. Now, if you have invested in Tesla and you have very strong conviction, it would be good to hold, in my opinion.
And I think it's also good to pay a closer look to what the shorts are saying at this point in time. I mean, they just announced their short positions. Well, they didn't announce it. They have to file SEC filings, because if they have a certain amount of money, they invest in the stock market and short something, they have to report that. So like the famous Michael Berry, which we discussed briefly last week about the short position. So yeah, going back to Kathy Wood's ARK Innovation ETF. So she's back in the China trade for sure, and it's lifting the overall sentiment in the country. So in the past 5 days, ARK Innovation, her flagship ETF, is up 4%, outperforming the S&P 500. For the past 6 months, it's a little bit of a different story. It's down 13% compared to the S&P 500's 15%. And from January 1st, ARK Invest is down 4% compared to S&P 500's 20%. So it's definitely, what do you call that? Not in tangent in terms of the broader stock market. So for those who are ETF lovers, like what our previous guests are, Biwi and Dr. Stephen Panmat, I'm pretty sure they don't have the ARK in their portfolio, but they're definitely outperforming still because they're invested in the ETF. So this is just a short interview of Bloomberg on Kathy Woods and her change of stance. In this interview, she kind of like, explains herself why the change in sentiment. But we're just gonna roll the clip for the first 2 minutes, because this interview is 20 minutes long, and we know our listeners have some other things to do. So this interview garnered at least 22,000 views. Let's roll the clip.
We've been talking a lot about Chinese stocks and you getting back into it. Talk to us a little bit about your thinking right here, because it was just last month that you pulled back on your exposure and were selling. What changed?
Sure. Yes. So thank you for inviting me, Carol. I'm very happy to be with you again. So we had been pulling out of China. We started last November, actually, after the debacle around the Ant Group IPO and really the banishment, it seems, of Jack Ma. And we saw increasing signs that the government was going to get tough on companies. We didn't know and companies which were more than unicorns. They had exploded onto the scene, and they had become so powerful, as had their leaders, that they almost seemed to be threatening the government. At least that seemed to be our take on the government's response. So we were a bit cautious, pulled away, and in fact, our flagship fund has moved out of most Chinese stocks. I think we were out probably late April, late May, somewhere around there. It might have been a little bit later. Gradually, you never know 100% of the time. I think the online education, really nationalization there, was a real valuation killer for the market. So I think that the market's going to be under pressure from a valuation point of view for a long time now, because that sort of thing was so unexpected. Even from those of us who saw the government tightening its grip on the country. But what we have done, we did after this last bloodbath in the stocks, we did try and sort through, okay, which companies are doing things the government likes. Right. And what we're seeing are those that are catering to tier 3, tier 4 cities, logistics, groceries. So you've seen us buy JD.com. JD Logistics is a big part of JD.com. I think they own 70% of it. So that's probably been our biggest purchase, as well as some Pinduoduo for the same reason. But if you were to look at what we were doing in those portfolios, we were really swapping them out of other names that we think are going to be continue to be in harm's way, or certainly under government pressure, like the Alibabas, for example.
So it looks like Huawei, she's still in the China playing field. She's rotating to more kind of like not defensive, but focus on a 3rd tier, 4th tier cities, she said, those that's supportive of those economies, like JD.com of China, not the big ones, the big sharks like Alibaba.
Not the big techs.
Not the big techs. Away from the crosshairs of the Chinese government.
Speaking of China, our SEC is asking more IPO disclosures from Chinese companies, and changing their wordings when they're applying for their IPO.
Yeah, I think that's good, because that way, some things can be further scrutinized and not just be like covered up with word salad.
And bad memory comes to mind. The Luckin, you remember Luckin Coffee?
Luckin Coffee, yes. Starbucks
of
China.
Played out. Starbucks, supposedly a competitor for Starbucks, then found out they were cooking their books, and then just went bankrupt.
Yeah.
So those, those types of incidents will, give warning to investors in China.
Right.
And disclosures is very important.
So Luckin went public, and then they eventually filed for bankruptcy, right? After they went public.
Yes, after people found out that they were cooking their books.
Wow. So probably lots of investors got burnt with that type of deal.
Yes.
So here's the last video that we have for today's episode. This comes from TD Ameritrade. This is important, especially for those long-term investors. So the title is Fed Tapering. What is it? And should investors prepare for a taper tantrum? So we're going to skip the first 2 minutes introductory, and we're going to play the rest 4 minutes. All right, let's roll the clip.
From rising to unhealthy levels. But the Fed doesn't immediately stop buying assets. Instead, it gradually backs off QE in a process called tapering. Tapering is part of the recovery process. It means the Fed feels the stimulus worked and they can back off a little. Basically, it's taking the foot off the gas, but not yet pressing on the brake. The gradual reduction is supposed to avoid disrupting financial markets, But it didn't work out like that when the Fed began tapering QE after the Great Recession. Back in May of 2013, then Fed Chairman Ben Bernanke told Congress the Fed could start slowing QE if the economy continued improving. But that surprised the markets, leading to a spike in volatility. The S&P 500 dipped 6% after the announcement, although this was a short-term dip, and it went on to close the year up around 30%. Over the 4 months after Bernanke's congressional appearance, 10-year Treasury yield rates jumped more than 1 percentage point. In December of 2013, the Fed started tapering asset purchases from 85 billion down to 75 billion. It continued reducing QE by 10 billion per month. Despite the initial shock to the market, tapering had a relatively mild impact to overall economic growth for 2013, with the economy still growing 2.6% for the year. This time around, as of August 2021, markets have barely reacted to the news that tapering may be coming. The Fed is eager to avoid a repeat of the taper tantrum of 2013 by laying a lot of groundwork publicly, so investors aren't surprised when the tapering plan is announced. There's no way to know for sure how markets could react when tapering actually begins, but here are some things to look out for and ways to consider preparing. Like we mentioned, as the Fed incrementally steps out of the market, historically that has led to upward pressure on interest rates, particularly further out on the yield curve. If you hold bonds that have a 10-year or higher duration, you may see some higher volatility. If you suspect a taper tantrum is coming, you may be tempted to pull out of bonds altogether, but consider moving away from longer dated bonds instead. This could help you avoid being locked into lower yields. Should interest rates rise, you'll likely want to be able to invest in those higher rates. It's not just the bond market that can be impacted by tapering either. The prospect of higher interest rates could dig into stock valuations. You may see stock volatility jump, but try to avoid making rash decisions. Defensive stocks like utilities and consumer staples may seem smart, but remember, Fed tapering coincides with a strengthening economy. So small caps, international stocks, and cyclicals like industrials and basic materials may benefit in this environment. But keep in mind that small caps are subject to erratic market movements and may have lower trading volume than securities of larger cap stocks. And international investments involve special risks, including currency fluctuations and political and economic instability. Since banks borrow on the shorter end and lend on the longer end of the yield curve, increasing rates are a boon to the financial sector as well. However you decide to weather tapering, try to set a plan and stick to it. There may be some turbulence in the markets, but this could create some opportunities as long as the economic backdrop stays positive. With new COVID variants swirling around, this may be a moving target for quite some time.
All right, Wowie. That's quite a quite a very informative segment by TD Ameritrade. Oop, I think Wowie froze. So what I could tell from this video is like, oh, hello,
Hello.
Wowie. I think I lost you there. Yeah. So what do you
Yeah.
think?
Oh, well, sorry about that little
That's fine.
technical difficulty.
Yes.
Well, that's a good advice, right? So start looking at small caps. And you can see, the Russell 2000 is going down compared to the other three indices. So it's probably a good time to buy, some ETFs on the Russell 2000.
Some small caps. And also she said when the Fed starts to taper or pull back some of its support for the economy, overall economy, rates would start go up. Like it occurred during the taper tantrum back in 2013. She highlighted that the interest rate went up by 1%. And as a result, banks can definitely make a little bit more money. So she kind of mentioned financials into it,
Mhm.
getting some exposure to financials. But overall, her bottom line is, make a plan and stick to it, and don't make rash decisions. I guess that's the way to go if you're trying to play the market for the long term.
Yeah, Bank of America is a big company that probably good to put on your watch list for this upcoming change. And
Right.
like she said, it's good that Jay Powell is setting up the expectations. He's
Right.
he's preparing
Yes.
people, for what to expect. When are we gonna taper, right? So there are
Mhm.
signals. They're all giving signals, and a lot of the Fed chairmen around the country are supporting the tapering.
Right. So the more that the consensus is, eventually investors hopefully will clamor for tapering. Well, we'll see. We'll see how it goes. Nobody can blame people or investors liking the stock market going up all the time. So it's
It will
overall
prevent,
bullish.
yeah, it will prevent panic in the
Mhm.
market.
Yeah.
So I think it's good to go ahead and
Excuse
start,
me.
preparing for the taper
Right.
and start acquiring, um, stocks or ETFs
Mhm.
that are taper proof.
Or reopening place. So, all right, before we end the show, do you have a quote of the week for us?
Oh yeah. So don't chase the money, chase your dream.
Oh, wow.
I don't know who I think it's anonymous. I don't know where it came from, but don't chase the money, chase your dream, guys
I
and
think
gals.
I think that's very important. Yes, for sure. So, for next week, Wawi and I we're gonna take a further deep dive into some shipping companies, like what Wawi has suggested earlier. I think it'll be a good sign for us to look at some of their balance sheets and numbers, and whatever
Yes.
pops up during this course of time until next Friday. Well, Wawi, thank you so much for coming on.
Thank you, Mark.
And yeah, listeners, that does it for this episode of Mark You and Wawi Show. Send your questions, or if you just want to say hi, send us an email at markyouwawishow@gmail.com or tweet me at marku_dpt. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark You signing out.
And Wavi Santos signing out.